start off with is just a little bit of supply data from the Daily Livestock Review. They have showed that we are continually in an expanding market, both in production and as far as inventory as well too. I don't think there's been any decrease at all in the expansion of the cattle market, although what we may be finding ourselves getting into is an area in which we begin to slow down the expansion a little bit and maybe make it a little bit more even keel. We went from a very abrupt liquidation to a very abrupt expansion. Now we're feeling the realms of that, and so we'll probably start to slack off just a little bit from here and in our beef production total as far as inventory goes. This is the first time that I've seen some blue in these numbers supplied by the cattle range, in which it shows projected feed yard closeouts, and they look very good for right now, and as data that I have acquired makes this look even better as we move on down the road. You can still see we're increasing in total beef production. We're at 3.1% for the year. I think this is going to continue at this rate as we don't see great changes one way or the other in the placement numbers nor the on-feed numbers. Marketing will be a big hinge to this. Tomorrow's cattle on feed report showing 100% on feed, 98% placed, and 101 marketed. This appears to be a relatively friendly number. So I am kind of still at awe with most people as to why the futures market continues to react negatively to very good supportive information. And that's what's going to bring us to kind of where we are right now. It looks like that the cattle market itself is in pretty good shape. The futures market has, with the discounts, has caused for a very interesting price scheme. That price scheme is that the highest price paid available today is today. Therefore, if you are a seller and need to move inventory, today is the day, and there's no need in storing that inventory nor holding it on feed any longer, because the weight gains could potentially not justify the price movement, or there not being any more price movement to the upside. On the other hand, we've got the fat cattle market on the futures, in which is severely discounted. So if I'm a packer and I'm needing cattle, I'm going to go to the futures market to buy that inventory, because the way it looks right now, I don't think that we're going to increase dramatically in placements going through the summer. I believe we've placed a tremendous amount of cattle this early part of this year in the first quarter. Second quarter placements should be down just a little bit from the first quarter. And then as we get into the summer months, as long as pasture holds out and we don't get into any kind of drought situation, I think that the backgrounders will hold cattle on pastures for as long as they possibly can to gain as much weight as they can to help offset this price decline. So at this time, I think that we still see packers in a position that is very friendly towards them in this pricing scheme. A couple of things that may come about that could throw a monkey wrench into this would be some kind of dairy cow liquidation. Milk prices have been severely depressed, and this has not been anything that has been in the works for a long. This has been something that's been in the works for a long period of time. So we're seeing continual milk price decline, and at some point in time, the only way that I know to cure all that is to start cutting the cows that they're milking. So that may become something. I have not heard of anything yet, but that is something to always look out for. Another could be anything that potentially says that the cash market will not be able to sustain these gains. So although the futures markets are severely discounted right now, I don't think they could get much more discounted until something started to slip on the cash side that showed where we might end up with a few more cattle on feed or potentially placed at some given month. This is from the More Research book, and it shows that right now here in May, we should probably stabilize off through this May time frame going into the 1st of June. The 1st of June, we slip back just a little bit, and then it's pretty much up from there. We see a small part from end of July to second week of July, from end of June to the second week of July, having another small downturn, but then it continues to be up from there. So with the more research and the favorable outlook on that, I'm not seeing too awful much in the fat cattle market that would make me want to hedge cattle at such a severe discount. when we progress through this, on my website, there is a page that on the front page, on the right-hand side, it is called Workshop Tutorial. And in that workshop tutorial, hedging workshop tutorial, you'll scroll down and you'll find several of these pages on here that are blank. I encourage you to print these pages off, and there's another one that allows you to calculate a projected price into the future below this one that will give you an opportunity to start penciling in what may or may not happen in the future, depending upon how you act or react today in hedging this market. So that's all the slideshow that I've got here, and I'm going to toggle over to a couple of things back in the fat cattle market. And the first one I want to come to is the weekly continuation chart. The weekly continuation chart really leads me to think that we should have a fifth wave new low. And what I am discussing is from this 4 right here, an intermediate wave 4, to this 5 right here. Again, I'm going to toggle back and forth, but this is what we're attempting to try to find out. It's this right here, and this is out of the major works for R.N. Elliott. But we've already had the A wave down, we've had a B wave rally, and we've got 1, 2, 3, 4, 5, and I believe that it is this 5-wave pattern right here that is this segment from this 4 to this 5 right here, and it should subdivide into 5 more waves. It needs to break and close. This is a weekly close only on spot month continuation, so we need to close below 120.72 in order to at least say we're now in the 5th of the 5th wave. The wave 1 of this wave 4 right here measured $6.85. If wave 5 is equal to wave 1 and we subtract 685 from this 4 high, which is 123.42, we come up with a 116.57 target. That might be a little difficult to do in the June contract with the premium that it holds, but it wouldn't be all that difficult to do if this wave 4 continues for the next 3 to 4 weeks and continues to move outward. Then we could see the discount in the August pickup actually not ever trade to new lows, contract lows via the August contract, but we could see the new weekly lows. The other hinge of this is if it's going to happen immediately, it may happen as soon as tomorrow or next Friday. And the reason I say that is we've already been today on the June contract below that price, 120.72. We were at 120.37 at our low today, so we've already seen that we can close or we can get down to that low still on the June contract. What that might suggest to me, if we see that this week or next week, I would begin to think that the extension down to the 116.57 target might not be as good as it is just a lower close by $1, $2, something like that, instead of all the way down to the 116.57 low. So here's our June contract right now. We're still kind of trading below the center of the range, and the center of the range to me is from contract low to this first move up, and then we start the wave count from there. Clearly nothing looks like 5-wave patterns to this, so I'm not real sure that there's anything definitive that says, yes, we're fixing to go straight up from here without any kind of looking back. But the discounts versus where the cash is, remember the cash is up in the 132 area up in here, it's a pretty big gap still left, and we've only got approximately 4 or 5 more weeks to go before expiration of the June contract. So if we get a lower close tomorrow, prior to the cattle and feed report that comes out, and if the cattle and feed report comes out relatively friendly, I think we'll move right back up in the June, continuing to narrow that basis. I don't see anything from the cash market standpoint, barring the dairy cow potential liquidation or something economically that we do not see yet to transpire that might cause something different than to transpire. So right now, I'm still looking for a market movement up towards the 128 to 130 area on the June. This week will be crucial to see if we close below the 120.72 low right here to complete this 5-wave pattern. Once that's done, the likelihood of me wanting to be bearish or short the market for an extended period of time is not going to be very good. I'm going to assume by that time we could move all the way back up into the 135, 140 area, which is where waves A and E and the top of 4 turned out to be. And that closing high right there was 139.82. So for the 134 cash trade already established last week, that is not that far off. It would be a far jump for the June to make that, but we saw April, and some of the other contract months in history do it with no trouble at all. They get into a situation where more cattle are needed than what is available, and because of the discount in the June and the guarantee of delivery, that's where I think traders will go to. So the August contract, again, with significant discounts here, those discounts alone make me not want to do anything. If you consider where the cash market is right now, if we were to drop all the way down to 118 in the cash market, that's where the futures are right now. And barring us moving dramatically into the 110 or below area, which I don't see that right now, then I see no reason to want to be short the June contract. A lot of these spike down trades have got closes a little bit above the center point of the range, so this one's just a little bit short of it, but the ability to pull off of these lows before the close and then the next day start trading a little bit higher, which I think we will. I don't want to lay all the blame on the Fed minutes from yesterday, but clearly we can see that we had adverse effect in every commodity, and that seems to bled over into the cattle market, and that's why I'm not looking at Friday's decline and today's decline as anything suggesting that this is a reversal and we should begin to anticipate a lower trade. We filled the gaps. We're actually trading sideways for the last 2 weeks. I think next most probably will move, barring tomorrow or Friday of next week, having something come in that puts us below the 120.72 area on the June. I think we're going to move higher than that. So move on to the feeder cattle. The feeder cattle this is the feeder cattle index. We already have the 5-wave move down. And the only real clear cut is this 1 and 2 here, and we don't know whether that's complete or not. We run into the same situation in the feeders as we do the fats right now, the biggest difference being we have a clear new low here versus the wave 3 low, where it's very iffy on the fat cattle market because we didn't quite go down near as much on here. All these 3 of these lows are very close to similarity. Because this is still perceived as the wave 3, we have 5 waves down here, this is part of an irregular. So this is the real wave 3, and we have already exceeded it, suggesting that the 5th wave still is in progress right now. Unfortunate of it is, it'll take a move all the way back up into here, which would be that low 132.97, before we can really confirm that this move is totally over with. And that would already project movement of August 132 way up above all these previous highs. So once you start clearing these 2 previous highs in the August fat cattle, that should determine that wave 5 is complete. So back to the feeder cattle. On the feeder cattle, we got a 5-wave move down. And the biggest difference between the feeder cattle and the fat cattle is the increase in inventory from expansion is going to continue. It might have slowed at some point in time the first quarter of the year, but likely it didn't slow by all that much. So the anticipation of continued inventory is there. If we continue to market these animals, which I think the price structure, again, of the fat cattle market encourages that, selling them on the front end, there's no need to keep them because they're not going to give you any penny higher in the future than they are right now. It encourages selling and keeping this market current. So the feeder cattle supplies are going to be here, and the question is now is how do we move those feeder cattle supplies into the yards in a timely manner instead of building them up all up into one time, similarly to last fall. Some of that will hinge on this summer's growing, pasture growing. If we run into drought situations and have to move cattle off, I think that could be very healthy for the market because it keeps cattle coming into the yards at a more level pace than waiting all the way to the end of August or 1st of September when pasture begins to play out and we begin a normal movement of cattle out of the pastures and back into the fall feeding time frame. So with that said, I don't think that we're going to see anything in the feeder cattle market as far as great big rallies. Turning to the August contract, you've seen this chart quite a bit, and I continue to look at the price structure right now as going to contract. We had begun to contract already up until this last decline right here, in which we expanded it by approximately $3.85 from its previous width. So if we continue with the contracting frame, probably up into the 155 to 160 area might be the extent this summer that we get. Our greatest problem right now is that we do not have confirmation that from this C to this 5 is complete. Because the alternative count would be that from this point right here to this point right here is actually a wave 1 of a larger degree. That would suggest this move right here as a wave 2 and anticipating a wave 3 that could be as low as 120 to 110. Before we get into that, I don't want to get that far towards the negative side just yet because I am fairly positive towards this market. How we deal right now between this little move, these little moves right here, I think they're going to turn out to be an ABC correction and a bigger B, and then we work ourselves up into the 155, 160 area. That 155, 160 area is going to be where I want to start taking action. I've been very hesitant to do anything yet. I know that the declines that we have seen have been very sharp and abrupt and make people want to do things, but I think at this point in time, the unknown is so great and the potential for a better price is good that I don't want to do anything just yet until we get some confirmation done. A close below this B wave low, which is 146.25, would begin to lead me to think that yes, we may trade lower, but not yet. If we trade up into the 155 area, this is what I want to do. And this could be to any contract month that best suits your marketing time frame. And I'll go through a couple of them, but the scenario will be the same on all of them. We have this middle ground in the feeder cattle right now, and that 155 area, again, looks like between 155 and 160 where we could move up to. I want to buy the 155 puts if we get there. So we struggle another week, another 2 weeks, and we're able to push the August contract up to 155. I'm going to be exposing myself to the most premium that I will be willing to assume at this point in time right off the bat. I paid $5 for it, and I'm only guessing at that because a 147 at the money is trading a little over 5 right now, so another 2 weeks of time goes by and we're moving higher and we deflate that option premium. So at 155, that option premium could be right at about 155, right about $5. Then I'm not going to do anything, and I'm going to sit there knowing that I have solidified a minimum sale price at 150. But if the market goes up further, I will pick a price somewhere between 165 and 167 or whatever the extent that this rally goes up to, and then I'll pick a price above that and I'll say at this price I draw the line, and it doesn't matter how much higher the market may or may not go from here, I'm willing to accept this price and I'll sell a call option. That call option will decrease the amount of premium that I paid for that option in case the market goes back down a little bit or stays right where it is. It lessens the burden of that $5 premium that I made initially. Then, if the market continues to trade above my strike price, then I begin to assume realized losses, margin requirements, and anything else above that area that potentially the market could go to. I'm creating a window, a synthetic short futures with still the highest price that I can achieve, that call strike price that I sell. The market doesn't do anything. It stays right here at 155, and it's now end of June, 1st of July. The option has depreciated some. The market hasn't done much of anything, and I'm still able to sell cash cattle at whatever your basis is at your area. The market goes down. It's now mid-June, early July, and something has transpired that has pushed this market lower. Whether the fat market has begun to deteriorate, the corn market has begun to rally, whatever the case may be, feeder cattle just go right straight down from here. At some point close to that 138.10, I'm going to look down through there and try to assess how low I think feeder cattle might go, and I'm going to sell a put option at that, and I'm going to create a window of opportunity. The bottom end of that window of opportunity being the lower put strike that I sell, and the spread between the window minus the premium is what my profit potential is. So what I do then again is I begin to negate some of that $5 premium that I had paid for it. In respect to that, I am also losing the potential to the downside to whatever level I choose to sell the put option strike price at. We can do this with any contract month, and I think I've done a little bit on September. The 8/25 is expiration, so this is the amount of time that we're dealing with. I think that's about 68 trading days. On the September contract, 154.30 is the middle of this right here, so if we're able to push back up into the strategy. I won't change strategies. The only thing that will change is the premiums, and those will only change by primarily the amount of time that is involved in it, because we're not dealing with too much difference in strike prices because all these prices are relatively close. So time will be the only issue. If this happens next week, if we get that opportunity to move this market up $8, $9 from here up into that 154 area range on the September contract, then that's when I'm going to do it. Of course, the less time that it takes for us to get there, the more premium that I will be paying for that. At 155, it looks like that would make money, pretty good money off of these cattle to be marketed in the August-September time frame. In the October-November time frame, it just depends on where you were able to buy them, but clearly we've seen the market down and still down for most of the month of March and April and haven't really gained much. So any newest inventory purchased that will come out in that October-November time frame should still have a fairly good break even if we're up in the 155 to 160 area. At the end of this program, there will be a time for questions, so I'll allow any questions that you may type. So write questions down as I'm going through this, and you'll be able to answer those at the end. There's a short survey at the end as well, and I would appreciate you filling that out for my benefit so that I can produce these the most efficient way that there is. I'm still kind of new at this and trying to make sure it's the most efficient way to get these messages out. So that's really about all that I know to talk about, because we've looked at the production side of it, and we believe that supply is going to be steady in the feeder cattle market for 12 months, 16 months, 18 months to go, because we don't feel that there's any decrease in expansion. The fat cattle market could have some marketing holes in it depending upon how the summer goes. If we get into a really hot June, July, and pastures don't look too good and prices haven't rallied too much, you could see some inventory moved into the yard instead of staying out there. That would fill some marketing holes. If we come up and it's a very lush green June, July, and backgrounders are keeping those cattle out on pasture and not wanting to move them in, then clearly we could start to see some marketing holes in there. So with the supply issue pretty much set, looks like, some evening out of the keel, then we should get some evening out in the prices as well. So the greater fluctuations that we've seen in price are anticipated to begin contracting. That contraction is probably going to be seen more in the feeder cattle than the fat cattle, just because of the basis alone. We have a very even basis in the feeder cattle right now. This is with the August and the index. It's 81 cents positive basis right now. Something interesting about this basis right here, that's a 5-way move down in the basis. So far, just a 3 up. If that basis were to widen out to about $2 or something, I think it might be you would be a buying opportunity for the futures, because you've increased that basis $2 wide, anticipating the basis to go back negative again maybe as much by the $8 as where we saw before, or even as low as the 12 that we've seen before. And what that would be, in my opinion, would be a rush to buy the futures, and the feeder cattle index just not able to keep up on the same timely manner as what the futures are able to do. They can move much faster and further than what the index can. So on the fat cattle, there's, again, not too awful much to do, because I think that the price scheme continues to encourage selling on the front end, which keeps cattle cleaned up and potentially not as great a weight gains on there, and that we could be seeing further sustainability in the cash market as we've had big kills and we've absorbed those kills and boxes have been able to remain higher. I believe that there is just a slight dysfunction between cash and futures here, and I believe that the cash market is being the most prudent and right at hand is correct and where it's trading at. So the last thing I really want to do is hamper that by selling a $8 to $10 discount in the futures, trying to hedge something that doesn't look like needs to be hedged right now. So that's really about all I'm looking at, and the biggest thing I want to keep up is what I want to do on these feeder cattle if the opportunity presents itself. And of course, I was asked this question earlier: what do we do if it doesn't do anything? What if we just sit here for the next 10 days and the market just starts slowly, gradually easing off from this point? I think it's going to be about the same thing as what we saw before. It's going to be a grin and bear it situation. I think that we are so far behind the 8 ball that most hedging that we do from this point forward without any higher trading to transact business at, it's just going to be terrible. And I hate to put it like that, but it just really is. And I think it's going to be a darned if you do, darned if you do, don't situation in trying to hedge this market. Options always are going to be favored at this point in time, because I don't want to eliminate any kind of upside potential, nor create significant margin calls while you're already under duress. If I happen to be wrong and we get a flash down, everything looks like it's going to go straight down, you sell the market, 3 days later we're right back up here at the top again. So I want to be patient more than anything, and probably most of you have seen that I have not been very active this last 4 or 5 weeks in attempting to do anything, because I think patience is going to persevere right now and keep us from making bad mistakes. If we do begin trading lower to the extent of back down under 140 and start retesting that 130 low, 138.10 low in the August, it's going to be a real tough judgment call to see if we sell down in there. I believe that if we are to that point, something else will have materialized fundamentally that will be more obvious than what it is right now. Potentially a rally in the corn. That's always something that's on the back of my mind, and most of you know I'm already long corn and want to remain long corn for the reason, just in case if I'm wrong on the feeder cattle and we do start back down again and I don't have any feeder cattle on, I've always got that corn position. Corn priced at this level, yes, can go down, but until this crop is over with, the likelihood of us going under 380, 370 a bushel again and revisiting those lows on the weekly chart, which is right in here, so under 350, I think we'll have to have some kind of really excellent weather and no moving of acres from beans, from corn into beans, and we've got all 94.3 million acres planted. So, and going to exceed the average yield over 166. So I think that's the only way right now that we're going to see a move back down into there. But we could clearly see a move back up into the 420, 430 area, retesting these tops right in here. So owning some corn right now, I think, has a lesser probability of going down and causing great damage. And even if it does, I remain unhedged on the feeder cattle for right now, which should hopefully give them some incentive to push back up again. So I think that's a little bit better hedge than maybe trying to sell feeder cattle in this area. So corn could be an issue, probably some point in time. Something economically could be an issue. As we sit here and watch this equities market not do much of anything, we seem to have a very solid top that we cannot get through. If we have to back down into this 1925, 1900 area to get a running start to loosen up some money, then that could weigh on the market some as we see some economic activity faltering that would cause that. Other than that, I don't see much else to really give me great cause or concern for a significant move to the downside. I think on the fat cattle market, we have one thing to overcome, and that's this minuscule fifth wave right here. It's a minor fifth wave, but it is important because if it were to be completed, it would then relieve a tremendous amount of my aspects that we're going to go lower from here. I think that 5 wave would complete a tremendous amount. We already have good divergence right here. Clearly, this is a lower low, and the oscillator is nowhere near a lower low. So we have some technical devices that are showing us that we could see some divergence, and that is always a clue as to a lesser amount of selling. Even though we've got a lower low in price, we don't have the same technical indicators moving down to those lows. So that's our problem or our issue to be faced with on the fat cattle. Clearly, it could be resolved tomorrow afternoon. If it is resolved tomorrow afternoon for a close of June under 120.72, I'm going to be pretty friendly towards that market. If we do not, and we have to trade all the way through next week, if we don't do anything next week, we could still be at this same level and still have the ability to make that low. Once we're through that, the next couple of weeks, then I go back to the more research and start looking towards that second week of June as a real move to the upside to begin from a seasonal aspect. And if we are still trading in the upper, or in the lower 130s for the cash market, some point in time we're going to see cash and futures meet, and we could see a very quick pop up to that 130 level in the June futures. So I'm pretty much all I've got right now. I spoke for a little over 30 minutes, so I'm going to open it up to some questions and see if anybody has any questions for me, and then after that I'll turn it loose for the rest of the day. Don't forget to fill out the survey at the end, and I would greatly appreciate that in order to help me to be able to produce these in a manner that is most beneficial to y'all. We'll give another minute or two to see if anybody has any questions or to wake up from having to listen to me. So Chris Winward, my sales associate, is fixing to take his Series 3, so he'll be a full-blown broker here before too much longer, and I encourage you to ask him anything that you want, and he has sure been a big benefit to me. So I have our first question. It says, what about the dollar? Will the rate hike allow it to rise again? The dollar has been rising in this particular range that we see right here. It's broken out of the sideways trading range twice, once right here and once right here, and that's a good 12-month-long trading range that it has been in. We've had this little spike within the trend channel, and I'm not real sure that we're going to get that rate hike that the Fed has suggested from their last Fed meeting on the minutes that they produced. So right now, I like the looks of that dollar probably reversing as it has come up here and meet that. It did this once before, right up in here. And I'm not real sure that I see enough correlation between interest rates, a rate hike, and the dollar. Bonds have moved up sharply the first half of the year and then plateaued, so it's difficult to see the correlation. Here's the bond market. As you can see, we moved up sharply the entire first half of the year, and then we've just now plateaued, where the dollar index has been this way for a long period of time, so much longer than what the here's where the dollar started, the bonds started up. The dollar had been going up and then plateaued, and now we're already showing evidence of the market moving back down again. So if we do have a rate hike, bonds probably would not be going up in price, and therefore I'm not real sure that we would see the same correlation between a rate hike and a continual increase in the dollar rise. I believe that everyone out there is looking to see which country is in the best, worst shape. We all feel that, you know, our country is in bad shape because we're having to continually produce all these low interest rates environment, quantitative easing, penalizing our constituents by charging them to hold their money. And just by default alone, if I were in another country and I did not want to suffer a penalty for depositing my money, I would trade it into dollars and buy bonds or an interest rate instrument. And by default, every time you buy that instrument, the rate of interest goes down some. So it's kind of hard to see where the Fed is looking at raising interest rates and we are still at higher interest rates, how that would not conform in some way to push the bond market higher, which in all honesty, all it would do is just reduce the yield curve that much further and make for even narrower profit margins for lending institutions. Because now you've got a higher interest rate on the short end that I'm borrowing at and a lower interest rate on the long end that I'm lending out at. And let's see, we've got another question here. Based on your analysis, would it be prudent to buy feeders at this level or a few dollars lower in anticipation of a bump back up to 155? Yes, if you wanted to speculate, I think that if you could risk a lower close at that 146.25 area right here for the feeders, yes, I think it's going to 155. My perspective for producers is more I'd rather not do anything and let it get to the 155 area. When I look at yards, for a yard to be buying thinking that, okay, we're going to move up to there, I don't really know that I would do anything more than maybe buy a window, buy a call option window, bull call spread similarly to the puts for a producer. I might buy an at the money 148 and sell a 155 or 160 or create a window in some respect that would give me a 3-to-1 ratio. For every $3 that I spent for a window, I would have at least $9 worth of profit potential in that. So yeah, I think we could move back up again to the 155 area, and that's what, if you want to take a speculative trade on that, I think that will have a good chance. The next one is a few dollars lower, 155 area. And what about crude? Okay, here we go. What about crude oil? Crude oil looks like it's in a really good up market. Something to remember about crude oil is every day there are guys out there with orders to sell 2 million barrels of oil. That's their job. Their job is never buying oil. They work for an oil producing company of some kind, and every day their job is to get rid of 2 million barrels of oil a day. So it's in an up move, and at any given time we could start to see some of those supplies being ramped up. But right now I think we cut production and cut enough that if we do go back down in crude, maybe we only end up into the below $40 area again. But right now it's an up move. These oscillator highs are bucking up against the March highs here, so I don't see any real divergence yet because we are still moving up, and because there is no divergence there, I don't think this move is over with. These highs over here to the left, the September, October, November highs, if you think about an inverted head and shoulder, there's your left shoulder. Draw a line through here is your neckline, your head, and you pull back up into the top of this shoulder area right here. So that is going to be right around the 154, 155 area. That high is 54.22, 53.77. So we pull up in there, and then what we start maybe seeing is the price is high enough to bring back onto line some of that inventory, and we start trading a sideways range for the remainder of the summer and early fall in that $54 to $46 area, and just trade sideways and create a rather large inverted head and shoulders. you'll see that pattern in quite a few markets beginning to develop. It's still a ways away from suggesting it is a true Head and Shoulders, but right now it sure has the aspects of one. Painting with a broad brush. Where do you see cattle a year from now? When I look at the weekly chart and just base it on nothing but the Elliott wave, I'd say that you're probably going to create some type of Head and Shoulders pattern in it too. With this being the shoulder, this right now the neckline and head, even if it's only minuscule, we should push back up into this area again. So if backwards and look over all the way over here, and we looked at from 05 to 09, look how sideways that we traded. Because what we eventually did is we had an even keel. We finally were able to fix cattle in a $25 trading range because the supply-demand factors contracted to this point where stability in price was managed within $25. Now we project forward here, and we have had an extensive explosion in liquidation, an extensive expansion mode, and now what are we going to do? We're going to start to level off on our supply-demand factor. We're going to start slowing down expansion, and we're going to probably start increasing our demand a little bit. And as we push through that, we end up right back up into this 140 area. So, and this time when the market starts to dip down, it probably doesn't dip down as low in the 120s. We stay between 140 and 130. I don't think that expansion will increase to any kind of significance, as in we're going to start holding back more heifers or putting cows back on life support systems to let them have another calf. That particular portion of keeping cows alive to just bear another calf is over with. I don't think that we're going to see that for any time soon. So heifer retention is going to be probably the key, as well as any potential in the dairy cattle market that might do it. And here's just a quick shot. This is June milk right here. So this kind of gives you an idea of what the dairymen are facing right now. We're sitting right here at $12 from a $17 plus high for the last part of last year. So they're hurting too, and cattle are cattle and they're all killed. So I think that this could put a real issue into the market if that were to start. May not. But right now it is something that is on my radar. Many thanks, and it's about 5:17, and I don't want to keep y'all any longer than you want to. So if you will, if you have any more questions, I'll be here for as long as you need me to be. If you want to call and ask a question, feel free to, and I'll be in the morning to field anything that you need. So thank you very much for your time and attention. If I can do anything for you, please feel free to contact Swift Trading Company.